Welcome to Standard & Poor's December Loan Market Overview Clip. I'm Steve Miller, a member of the Leverage Commentary and Data Team, a unit not part of the S&P Ratings Agency. For the next 5 minutes or so, I'll walk you through a review of recent loan market trends before winding up with some themes to watch for in the month ahead. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. You've seen this before. It's a long and detailed disclaimer. In November, strong technical conditions allowed loan prices to weather Europe's stormy sovereign debt situation. The S&P LSTA loan index posted a 35 basis point gain. For the first 11 months of the year then, loans are up 9%. The new issue market also benefited from muscular demand. Despite a surge in institutional loan supply to a post-Lehman bankruptcy high of $28 billion, clearing yields narrowed again in November. Primary volume was paced in November by a slew of dividend financings. In all, issuers rolled out $14.5 billion of recap-linked loans and bonds, the most ever in a one-month period. That brought dividend-related volume for the first 11 months of the year to $50 billion, the most since 2007. LBOs were also back in style as sponsors announced 3 large mid-cap public-to-private deals, J.Crew, Cineverse, and Del Monte. Default rates were a little changed in November at 2.25%. Still, that's far inside the all-time high set a year ago. As this chart illustrates, LCD's flow name composite, a measure of the 15 largest, most liquid loans, drifted sideways in November. While investors pulled in their horns a bit in response to plentiful new issue supply and the overall worries related to Europe's sovereign debt situation, prices proved resilient. As this suggests, demand was robust. For one thing, retail investors poured a record $2.5 billion into loan mutual funds, according to Lipper FMI. For another, issuers repaid $8.6 billion of institutional loans, much of which was reinvested back into the asset class. For these same reasons, demands for new issues remained high. With accounts enthusiastically subscribing primary issues, new issue clearing levels declined to a 6-month low of 6.4% in November. Going into year-end, a flood of early December launches helped to stabilize new issue pricing as accounts piled through the biggest primary calendar since 2007. With a 35 basis point return in November, the S&P LSTA index was up 8.8% over the first 11 months of 2010. During the same period, the Bank of America Merrill Lynch High Yield Master Index was up 13.2%, and the S&P 500 was up 7.8%. Institutional loan volume jumped to a post-2007 high of $21 billion in November. Still, the pool of institutional loan assets shrunk $5 billion to $506 billion as a result of bountiful repayment activity and the fact that some November launches have yet to fund. At the same time, retail investors continue to pour capital into the market as previously discussed. These trends help fortify the loan market against the wobbles felt in both high yield and equities in November. Still, with volume on the rise, it's not for nothing that secondary prices were range-bound in recent weeks, as were new issue clearing yields. Turning to the credit picture, things were steady state in November. 2 loans defaulted, leaving the loan default rate unchanged at a 2-year low of 2.3%. That's about a 1.5 inside the historical average and down from a peak of 10.8% from last November. The market continues to benefit from 3 helpful trends. First, the improving fortunes of corporate America has fattened cash flows. Second, strong liquidity has allowed issuers to refinance and extend maturities. And third, so many issuers defaulted during the first half of 2009 that the field of troubled borrowers is far more limited today than it was then. Looking ahead, most managers expect default rates to remain low in 2011 at between 1% and 3%. Of course, worries abound that an exogenous shock, whether an oil price spike, a sovereign default, or a geopolitical event, could send the economy back into intensive care and send default rates back up as a result. To wrap up then, some final points. Volume will finish the year strong. LCD's forward calendar of new paper stood at $33 billion at the end of November, twice the average of the past 12 months. Looking out to 2011, arrangers expect a flurry of deals in the first quarter, with a mix shifting towards M&A and away from refinancings and extensions. Dividends, meanwhile, will continue to be hot if the market is supportive. On the other side of the ledger, players expect demand from retail funds and crossover accounts to persist as these investors look for a way to hedge rates. Managers say that loans, in fact, are one of the few asset classes that offer decent distributions alongside rate protection. After a stunning rise and then fall, default rates appear to be settling in a 1 to 3% band. But while most players are sanguine about 2011, further out managers worry about an economic double dip or an exogenous event that sends default rates hurtling higher. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video. As mentioned, you can also download the presentation at slideshare.net.